Many Pacific women rely on their husbands to provide the money necessary for food, school fees, and other needs. If their husband is suddenly injured and can no longer work, some women can be left without any means of support. Events like injury or death, livestock sicknesses, large storms, or severe floods can be enough to drive a low-income family into abject poverty, from which it can be extremely hard to recover. Bearing the costs of risks is part of our daily lives. While some risks are more predictable than others, we need to develop a plan to limit their negative impacts. And there is one thing that can help limit the size of the risks we live with, and that's insurance. Standard insurance is what many people use to protect their possessions, families, and lives. But standard insurance is often not affordable or available for most low-income families and those who live in rural communities. Low-income families also have the least amount of resistance to these risks. In recent years, a new concept called microinsurance has been developed to help those living in rural areas and in low-income situations.
Microinsurance offers families a way to face risks, so that when the worst happens, they have the resources to deal with it. Microinsurance differs from standard insurance because it is designed for low-income people. The level of coverage and the cost of the insurance for microinsurance are lower and more affordable. The high cost of providing insurance to low-income people, who usually live in rural areas, is managed through working with groups or communities instead of individuals. This is one of the benefits of what is called risk pooling. Risk pooling is based on the law of large numbers, which proves that when groups of people bear the burden of risk together, every individual in the group has their risk limited. The concept extends further to show that the larger the group, the smaller the risk each member takes.
As an example of risk pooling, these 3 women fish every day to catch food for their families. On average, every day, each woman catches 6 fish, and when they're lucky, they can catch up to 12 fish. But one woman may also have a bad fishing day and not catch any fish. So at times, one of their families may go hungry that night. But if the women pool their catch, instead of fishing individually, they decrease the risk that one of them will have a bad fishing day. When they put all of their fish into one basket at the end of the day, and then share the catch equally, each of their families can eat. If the women want even more security for their catch, they could get more women to join their fish-sharing group. The more people that join, the more predictable the daily catch would be. When the group is big enough, they will each take home the group's average catch of 6 fish every day. This is the law of large numbers and an effective risk pool. In this way, the women can better plan for the future, since they can depend on having enough food to feed their families every day.
Throughout the world, microinsurance is used to help low-income families and small businesses. In many cases, it has helped prevent people from falling into extreme poverty when there's a crisis. Many different models have been used, working within the cultural and social systems of each country. Numerous products are now offered, covering everything from cyclone and flood damage to farm animals, crops, and life insurance. For the Pacific, microinsurance as a financial product is still new and is just being tested. But the idea of a community helping individuals in need is as old as the oldest village on the oldest island. Microinsurance complements traditional systems of social protection. The Samoan Fa'alavilave, Fijian system of Vewekani, and the Greater Melanesian Wantok culture are all designed to ensure that family and community members can meet their basic needs. Today, Pacific families are burdened with many more responsibilities than what these cultural systems were envisioned to cover.
Poverty in many Pacific nations is rising, and a few now have some of the highest rates in the world. Families struggle to pay for transport, school fees, healthcare, and feed their families, while still trying to fulfill cultural obligations and improve the quality of their lives. For many of these families, an increased risk pool could help mitigate some of these issues and help keep them on a path to a better quality of life. Products are also increasingly designed with women in mind, recognizing their key role as household resource and risk managers. Women are therefore the ideal policy holders. But women are also more exposed to risks than men, and so they have an increased need for microinsurance products to mitigate that vulnerability. There are many popular products for microinsurance that have potential in the Pacific and which are working elsewhere. One is health insurance. Another is funeral insurance.
The challenge is figuring out how to distribute, promote, and service these products. Any successful ventures will likely be based on partnerships between CSOs, rural associations, credit unions, microfinance institutions, and insurance companies, with support from the government or donor agencies. Funeral insurance is one of the most common forms of microinsurance. Around the Pacific, funerals are traditionally very important events and usually very expensive. In the midst of mourning, family members are too often forced to worry about how to collect enough money to hold the funeral gatherings than how the family's basic needs will be met afterwards. Funeral insurance can be designed to cover the funeral costs of the deceased or extended to cover other related costs. Either way, it helps reduce the burden of death upon the surviving family in a time of need.
La Equidad, a microinsurance company in Colombia, South America, offers a product called Amparar, which covers funeral expenses, groceries, and electricity for 1 year. It also has an option that covers education expenses for 24 months. Amparar was able to offer this product for a cost of only $10 to $12 a year. The product is popular with low-income women, enrolling over 10,000 members in its first 15 months. It is also profitable for the insurer, providing a profit margin of over 20%. Currently, there are approximately 30,000 low-income families who benefit from this product. HFC in Fiji has recently launched a funeral policy in the Pacific and is currently building the size of its risk pool.
The reason for taking this policy is most of us today, even the hardship we'll be facing, according to money concern, when some in the family passed away, it is very hard to cater for funeral finance. It affects my family in how my kids are going to for education and the continuation of a payment for this house, property.
When someone has to take care of a relative who has fallen ill, there are often many secondary costs, like travel, food, and accommodation. Discussions around the Pacific have indicated that there is a demand for a product that covers these costs. Healthcare concerns are paramount among the world's low-income populations, and research shows that here in the Pacific, many rural populations rank healthcare as their primary concern. While this means that there is a high potential demand for microinsurance products for healthcare, health products are considered one of the most complicated to successfully offer.
Globally, different organizations have designed innovative models that solve some of the problems fundamental to this product. Dr. Devi Shetty, an Indian surgeon, became interested in health insurance as a means to extend services to rural communities that did not have the financial resources to visit the hospital. He understood that to make any product cost-effective, he would need to have a big enough risk pool. One of Dr. Shetty's initiatives offered a health scheme to a farmers' cooperative that covered expensive surgery costs. At the product's launch, they registered 1.6 million farmers and now serve over 3 million people. The Indian government partially subsidizes the benefit, while the state cooperative department helps promote the product. Cooperative societies then enroll new members, and cooperative banks assist in the collection of premiums. These crucial partnerships keep the product very affordable. Premiums cost just under $3.25 yearly per family member, with discounted coverage for children. Also in India, an NGO called Karuna Trust partnered with UNDP and the state-owned national insurance company to offer a product that covers income loss while a person is hospitalized. In this case, premiums are collected at self-help group meetings, and social welfare officers attend the meetings to build awareness about the product. Premiums are only about 50 US cents per year and provide benefits just above the daily wage for a farmer or seasonal laborer.
Lessons from around the world have shown that successful microinsurance models will be demand-driven, involve significant client education, and have innovative distribution networks. There is every reason to believe that it will also work well here in the Pacific. Small-level initiatives have been launched in PNG and Fiji, and many more providers are looking for ways to design profitable products. There is a need, though, to first conduct more research to design demand-driven products and form the partnerships that will allow microinsurance to be implemented throughout the Pacific in a cost-effective manner. The Pacific Financial Inclusion Program is actively supporting microinsurance initiatives in the Pacific and encourages those interested to contact them directly. Although microinsurance will not remove the risks that Pacific Island people face, it can help alleviate the financial burdens of those risks that could otherwise push families even deeper into poverty.